At the western edge of California, in the coastal city of Goleta, sunlight scattered across gleaming semiconductor wafers. In a quiet laboratory, engineers worked with invisible waves of light, chasing a dream that could change the very foundation of computing itself. Not electrons, but photons, moving circuits. And at the heart of this transformation stood a company few had heard of until recently, Aeluma. Aeluma is not a typical semiconductor company. While most of the industry still relies on silicon chips powered by the flow of electrons, Aeluma is pioneering photonic semiconductors, devices that use light to transmit and process information. At the core of this effort lies compound semiconductor integration, a method that grows materials made of elements from groups 3 and Vi on large diameter wafers. This innovation promises something extraordinary: the ability to push computing and communication speeds closer to the speed of light itself. Founded in 2019 and headquartered in Goleta, California, Aeluma began as a small research startup staffed by only a handful of engineers. Yet within just a few years, this obscure name appeared at the center of the US government's strategic technology map. Between 2024 and 2025, Aeluma secured 4 major government contracts from NASA, DARPA, Defense Advanced Research Projects Agency, the Department of Energy, and the US Navy. This is not normal. Under standard procurement timelines, a new technology firm might spend 3 to 5 years moving from proposal to contract approval. Each agency requires exhaustive technical validation, financial auditing, and facility inspections. Aeluma, however, moved through this process in record time, roughly 1/3 the normal duration. Each project was significant in scope. DARPA assigned Aeluma to develop heterogeneous integration, the advanced process of bonding dissimilar semiconductor materials onto a single wafer, an essential step for merging photonics and electronics. The Department of Energy funded its SWIRE, shortwave infrared photodetector commercialization program, designed to enable next-generation imaging for autonomous vehicles and defense systems. Meanwhile, NASA and the US and Navy contracted Aeluma to create high-speed photonic sensors and quantum communication chips. In less than 2 years, 4 top federal agencies had converged on a single, small-cap company. This was the first anomaly, and it immediately drew attention from investors. Why would so many US agencies choose the same startup so quickly? Was it merely a reflection of Aeluma's breakthrough technology, or was it a deeper, coordinated effort to secure America's leadership in light-based computing? Perhaps, some speculated, Aeluma had quietly achieved a critical materials breakthrough, one that others in the industry had failed to reach. Then came March 2025. Aeluma was approved for listing on NASDAQ. Typically, a deep tech startup preparing for an IPO undergoes at least 2 years of preparation, audits, financial structuring, and roadshows. Yet, Aeluma's path was lightning fast. The company priced its shares in the mid-$5 range, issuing roughly 2.2 million shares, raising about $12 million. Within days, the offering was oversubscribed and closed near $13 million in total proceeds. The IPO was a success. Investors were captivated by the combination of government validation, cutting-edge technology, and growth potential. But then something unexpected happened. Only 6 months later, in September 2025, Aeluma announced a second, much larger public offering, approximately $25 million, nearly twice the size of its first. For context, it's highly unusual for a newly listed company to return to the capital markets so quickly. Normally, a company waits at least a year until it has reported stable earnings to justify new fundraising. Aeluma broke that pattern completely. The company claimed the proceeds would be used for manufacturing readiness and facility expansion. Indeed, the following month, Aeluma purchased major fabrication equipment and production assets, signaling a shift from research to pilot manufacturing. Yet this move puzzled analysts. Why expand capacity so aggressively before consistent commercial revenue? Traditionally, semiconductor startups partner with external foundries, outsourced manufacturing facilities to minimize upfront costs and reduce production risk. Aeluma, however, chose the opposite strategy, internalizing its production capabilities early. That decision revealed both ambition and risk. On one hand, in-house fabrication gives the company full control over intellectual property and process quality, key advantages when scaling photonic devices that require extremely precise alignment. On the other hand, it dramatically increases fixed costs and accelerates cash burn. Two interpretations emerged among investors. The optimistic one suggested that Aeluma's management had already secured early customer commitments or government demand forecasts, justifying the accelerated scaling. The cautious one pointed to a possible yield issue, a lower than expected ratio of functional chips in pilot runs, requiring additional equipment and process refinement. In semiconductor manufacturing, yield is everything. On large diameter wafers, even microscopic defects can destroy entire batches. Low yields lead to skyrocketing unit costs and eventually financial instability. Most young companies mitigate this by outsourcing early stage production to reduce operational risk. Aeluma's choice to expand internally, while admirable, was unconventional and possibly revealing. Around the same time, Aeluma's leadership team evolved. Mike Byron, formerly a finance executive at NVIDIA, joined the board of directors, while Christopher Stewart, who had extensive experience managing finances for public tech companies, was appointed as chief financial officer. These hires were not random. They represented a strategic restructuring. Aeluma was arming itself for more complex financial management, balancing aggressive R&D with disciplined capital allocation. Financially, the numbers told a paradoxical story. In 2025, revenue grew more than 400% year over year, yet the company remained unprofitable. Net margins hovered near -60%, a deep loss typical of pre-commercial deep tech firms. Under normal circumstances, such sustained losses would quickly erode liquidity. But in Aeluma's case, cash reserves remained strong. The reason lay in the structure of its government contracts. Federal R&D programs like those with DARPA or the DOE release milestone-based payments, steady inflows that can offset operating losses even before commercial revenue begins. As a result, Aeluma's income statement looked weak, but its cash flow statement looked unusually healthy. This disconnect became the third major mystery. How could a company lose money on paper, yet maintain strong liquidity? The answer, though rational, underscored Aeluma's unusual financial anatomy. Its growth was being financed not by product sales, but by government-backed validation. Taken together, the story converges on a singular crossroad: technology, capital, and market validation. The technology has been proven. The capital has been raised. But the market, the ultimate test, remains ahead. Investors now focus on two indicators: cash burn rate and customer conversion speed. Once pilot customers begin signing recurring production contracts, Aeluma's valuation model will shift dramatically from speculative to structural growth. But if that transition drags, another round of fundraising could become inevitable. In November 2025, Aeluma is scheduled to release its first earnings report of the new fiscal year. For the company, this is more than a report. It's a reckoning. Every decision of the past 2 years, from rapid government wins to aggressive scaling, will either be validated or questioned. And so the mystery remains: has Light truly delivered performance? Have new facilities reduced cost? Have customers begun ordering again? If even one of these answers turns out to be yes, Aeluma's value will need no explanation. But until then, this story remains open, glowing with both promise and uncertainty. For those watching this story unfold through short clips, you can click the full version link below the video to listen without interruption. Before we close, ValueStir invites you to join the discussion. If there are listed, unlisted, or pre-IPO stocks or emerging crypto assets you'd like us to investigate next, share your suggestions in the comments. Your insights drive our next analysis. And to everyone who watches, subscribes, likes, comments, and shares our videos, thank you. Your support helps us continue delivering deeper, smarter stories about the world of investing. This was ValueStir.